Options bleed daily, futures don't, and prop firms sell $50,000 tryouts. Most fail. The catch comes after you pass. Here's the breakdown. If you buy SPY or QQQ options, the clock works against you. Every day, time decay eats part of what you paid. Futures don't have that clock. And for day trading, that changes everything. But here's the real question. Your own money or a prop firm's $50,000? Today, the honest breakdown. Futures versus options. Your money versus a funded trading account. And the one rule that decides whether you ever see a payout. Most beginners never check it before they pay. Start with the clock. An option is a contract with a countdown. Part of its price is pure time. Every day that passes, time decay eats it. Traders call it theta. You can be right on direction and still lose money because you were too slow. A futures contract is different. No option premium to pay, no daily time decay. Every 1-point move in ES is $50. On NQ, $20 per contract in both directions. Now, futures do expire 4 times a year, but nothing melts while you hold. You just move to the next contract. And how long you can hold depends on where you trade. Same indexes, different game. So, whose money should you trade them with? So where does your futures trading capital come from? Option 1. A personal account. Your money, your rules. Hold overnight, swing for weeks, roll to the next contract. But the losses are real dollars, and it takes more capital than most traders expect. Option 2. A prop firm. You pay a monthly fee for a tryout called an evaluation. Trade a simulated account, say $50,000. Sizes vary by firm. Pass, and they fund you. A funded trading account. You keep most of the profits. One trade-off. These are day trading accounts, flat by the end of each day at most firms. Topstep, Apex, Tradeify, an entire industry. Sounds like a cheat code. It isn't. So, what's the catch? Here's the honest part. First, prop firms are not charities. Most traders fail the evaluation, and between evaluation fees, reset fees, and activation fees, the tryout itself is the business. That is how prop firms make money. Second, the trailing drawdown. Your maximum loss limit rises behind you as you profit, and at many firms, one bad trade can touch that floor mid-session and end the account instantly. Third, that funded account? At most firms, it is still simulated. The firm pays you from its own revenue. None of this makes prop firms a scam. It makes them a filter with an entry fee. One rule matters more than all the rest. It can turn your best day against you. The consistency rule. The biggest hurdle between you and a payout. Many firms cap your best trading day at a share of your total profit. Say you need $3,000 for a payout, and the cap is 50%. 3 steady days, $500 each. Then one great day, $2,000. Total, $3,500. Pass the target, right? Not anymore. Your best day is over half your total. The bar moves to $4,000. Your best day just raised the bar. Some firms delay the payout, others raise the target to pass. The firm is not paying for home runs. It screens for repeatable, boring, everyday edge. And that is exactly what algorithmic trading is built for. So, are prop firms worth it? Real capital, full control, hold as long as you want? Personal account. Small budget, defined risk, while you prove yourself day trading? A prop firm evaluation is a cheap test. Either way, you need an edge, a repeatable advantage that shows up every single day. That is the whole case for algorithmic trading. Next video, we build one. I download real ES and NQ data, hand it to Claude, and make it backtest a strategy. That means testing it on years of past data. The exact prompts included free. Subscribe so you don't miss it, and tell me below, your money or their money?